Hello and welcome everyone to the Delphian Weekly meeting. Thank you for tuning in. So today's agenda, we'll go through the market update our earnings trades, and I believe Joe has some charts we'll go through. So let's get started. Yeah, I was just going to point out kind of the big news. This 10-year, we always keep a close eye on that. So that's popped up pretty strong, which is dragging down the equities. So any kind of big upward movement in that, it's bad news for stocks overall. So we'll look at that chart in a little bit. But overall, nothing changed from last week as far as the indices, all in one. We had, green pies pretty much, flat from the previous week meeting. The state ones that's, are over bot conditions 45. So, it's been right up there. It hasn't got up to 45, but I mean, it's, right in that range. So let's look at so this is the bullish bearish. So you can see, we've been over 70, and I think Joe said it's like on average, it'll be up 16 days, trading days above 70 is kind of the average. So I'm not sure.
That's right, Josh. Yep.
So I didn't count the days that just popped in my head, but we're probably getting right around that kind of average. But you can see we kind of topped out here at 77. So just been kind of chopping along. Obviously, if the average holds up, then we would be turning back south here. If it follows the average over 70. So new highs. Obviously, this is good news here. For bullish people. Not getting a lot of the bearish ones here. But just kind of a big shift right here. Where we're getting a lot more of the highs. So that's bullish overall. Overall, we have our ones. All the indices are in one. It's just overall bullish kind of action. So what happens when we're in kind of a bullish type of environment? Basically you're going to go 1 2 1 2, so stay one, then pull back, stay one, pull back, stay one, pull back. Maybe goes to a 4 once in a while, but if we continue with this kind of trend here, that's what I'd expect. 1 2, that type of action overall. Our SMAs are broke out pretty good here, so we got really good separation. So a lot of things pointing towards bullish overall. Obviously, we're at extended levels at this point, so that's kind of more of the medium term, pointing towards bullish. But short term, like I said last week, I mean, we're most of the gauges, we're almost 45 here. We're a couple of weeks over 70, so short term's kind of pointing towards a pullback here. So that's what I would expect. Once we get this kind of momentum, we'll have to see if it turns and crosses. But that's pretty much what I see here from the market pulse. Now, when we look at the individual indices here for the modeling, obviously this one's kind of off the chart. Been in here a long time. Almost double the average days, well over double the move, that type of thing. So not getting much information off of this, but we can go to the chart. So what I said last week, our range here is 46 to 42. So I said, keep your eye on that. 46 should be strong resistance, and that has held up so far as pretty strong resistance. So that's a near-term ceiling, that 4,600. So on the way down, that 50-day is going to be key level. That's at 4,400. So that's your kind of ranges for SPX. Strong resistance. It tried to get above that 46, but pretty much failed, and that coincided basically. You see, get a 4607. That was it. One day, popped above there and couldn't break the next few, and then obviously returned pretty sharply lower today. So near term 4,600 ceiling, and then our 50-day is going to be critical on the way down here for support. So it's done a good job. So if we get a normal pullback, it'll come down that 50-day. If it's more than that, then obviously the below that's a 4,200 is the bottom of this range, that 400-point range. Another kind of intermediate would be this target 3, which provided good support here, and basically it just took off. So that would be another level below that 50-day moving average. So that's it for SPX. Russell, obviously, nice little chart here. So pretty much like this, right? Our average. So ran up in the resistance here, didn't pull all the way back, so I wouldn't call that like a deep dive, like a normal. So, kind of extended it, got into this 1 to 2 range, hit the 2. So today we're going to be significantly lower. This is the entry price. So that's the support level 1915, call it. So, if we get a normal kind of pullback, we could get down into that range. Obviously below that's our critical support level 1900. So, if we get some downward action, it's going to be really, critical to watch that 1900 level on the Russell. So, but, kind of acting normal at this point, ran into pretty good resistance here, like we talk about all the time in this 1 to 2 range. So that coincided with, basically the run up in SPX getting up to that 46, same type of thing. We got up here, you can see the high, 2000, let's call it 4. So, something we've been kind of monitoring was, we're making lower highs. So, this one was 2030. This one was 2008, 2009 kind of range. So this one we got up to 2003. So we didn't make new highs. Obviously it's not over yet, but we're still making lower highs here. So that was this kind of 2009, 2008 range. I highlighted last week, and basically, failed. Same time, SPX failed at the 46. So what can we expect here short term? The longer term, it's kind of set up, showing a lot of bullish, but, short term obviously is, showing bearish right now. Overbought levels run into resistance. Market pulse saying, pretty much overbought. So that's where we're at. This is a key thing to watch. Our 10-year, it's been getting a lot more active. So I'll pull this out. So, that 3.5 level was kind of like the base for a while. Looks like it moved up to like 3.75 kind of, where that's kind of like the floor, but, we got a big jump here. We haven't been this high in quite a while. The 52-week high is 433. So just keep your eye on this. This thing keeps going up. That's bad for stocks. I mean, cost of capital, all that stuff is going up for all the different companies. And last time we had this big spike, we ran into banking problems. 10 years, something to keep your eye on, obviously, critical. Fed, so.
Hey, Josh.
Yep.
Did you see the news about the Bank of Japan?
Mm-mm.
So the Bank of Japan, and this is what CNBC is saying is leading to this 10-year rise. The Bank of Japan has forced their long-term rates to be like 0.5 and short-term rates to be negative for like 20 years. And it was just a few days ago, they said they're going to let the long-term rates rise. And that's when we saw this big drop. It was 2 trading days ago.
Mm-hmm.
And the 10-year went up. And the theory, according to the talking heads, is that, if rates rise in Japan, Japan being one of the largest foreign buyers of U.S. treasuries, then the U.S. is going to have to drop the price of their treasuries to attract more buyers because the Japanese will buy at home. And that is causing, at least what they're saying, that's what's causing this spike in 10-year rates. And if it keeps going, it will be bad for stocks.
Well, here's what I would think. So if you're holding Japanese debt and they're going to let it go higher, you're going to get out of that before it spikes, right? So then you'd have to reallocate it because your bonds yielding 0.5 are going to be worth a lot less if you can get 3% in a month or something like that, right? So you'd want to at least dump that and go somewhere else. That's how I would think about it. I'm not sure. I heard a little bit about it, but I haven't followed up too closely on it. This kind of what I saw was this downgrade. Obviously, regular corporations, when they get downgraded, their cost of debt goes higher, right? So I'm not certain that's exactly how it works for governments, they especially like the biggest one out there, but that I think contributed. I'm not too sure about the Japanese one though. I'm sure
they're referring to new issues. The Treasury does auctions, I don't know, weekly or whatever.
Yeah.
Ever since the debt ceiling was raised. And so the talk was if Japan lets their long-term rates rise, when you're putting new money to work, the Japanese who buy a huge amount of U.S. treasuries not necessarily buy as many because domestic rates are becoming more attractive.
Mm-hmm.
And that would cause then the price of U.S. treasuries has to go down, meaning the yield has to go up.
Right. Okay. I get you now.
Yeah.
Because you said you down, and I'm like, wait, no.
If you're already in 10 years and you're in Japan and you're at 0.5%, you're right. You're stuck. You got to get out of that. But these auctions occur weekly, and there's always new money being put into them.
Right. Yeah, to be competitive, they'd have to,
to be competitive, and that's what. And that's what I heard 2 days ago on CNBC, which makes sense. I'm not that familiar with the Bank of Japan or how that affects us, but then of course we had the downgrade on top of that.
Right. Yeah, I know the downgrade. The cost of all this government lending is just going higher and higher. I mean, it's going to be taking up more and more of the budget, right? You know, just costs more to lend. So,
because there's this thing called the yen carry trade that has to do with these interest rates. I don't understand it personally, exactly how this yen carry trade is, but it's been going on for a decade for I guess for the Japanese, and it's made them money. But if the rates rise at home, then that yen carry trade doesn't make as much sense, is what they say.
yeah, I mean, it's basically like you're borrowing somewhere, like maybe Japan at a super cheap rate, and then you're like doing like swaps for like currency and, you know, using that money to get debt elsewhere, stuff like that. I mean, it's like a hedge fund type trade.
Right.
Yeah. But you're basically borrowing somewhere else, you know, with cheap rates and, you know, like hedging the currency risk, that type of stuff, I think. So it's beyond our scope.
Yeah. Well above my pay grade.
Yeah, yeah. So, well, it's an interesting point. Yeah, I'd have to look more into that. But obviously, you know, lots of different things affect rates and stuff. So it's not like a, you know, straight correlations. There's lots of inputs. So thanks, thanks, Adair. Yeah, so Fed, you know, nothing priced in too much as far as next meeting, you know, end of year, kind of same thing, you know, kind of holding fast here a little bit for a quarter point by the end of the year, but nothing real big there. So, all right. Balance sheet, just kind of slowly draining. They're doing what they're saying. So nothing big here. Yeah, the rates. So just want to pull this up. So, I mean, these rates, you can get some good return right now. You know, 10 years gone up, it's over 4. So, you know, the inversion's like 0.9. It was like 1% the previous week. So, you know, just kind of moderating, you know, still well inverted. But, you know, you get really good rate. I mean, 1 year, again, 5.4, so 5.5. So, you know, it's good returns to be had out there. For, you know, these bonds, you know, if you basically buy them and hold them, you know, if rates go higher, you know, the value will drop. But, you know, you're still, you know, if you want to hold it for 10 years, you know, you get 4%, you know, pretty much guaranteed. But, you know, still inverted, and rates are going up, you know, currently. So we'll just have to keep our eye on that. You know, if this thing keeps spiking, you know, I'd watch out for equities, honestly. So, and, you know, keep our eye on the banks too. You know, their balance sheets are, you know, hopefully, you know, a lot of them did some fixing, but I doubt it. You know, so I'm sure there's still a bunch that, you know, haven't fixed it, but so that's something to keep our eye on. You know, if these moderate, then obviously, you know, we can resume higher for the equities and just kind of, you know, it's the next level. So that's 4,600 here, and then, you know, making new highs for the Russell. But if we continue down, you know, 1,900, you know, then at 44 is that 50-day. So that's where we're at. And looks like I got bumped off here. Any questions, comments? No? Okay, let's go and look at the earnings real quick. Earnings have been doing pretty good. Not sure what happened here. We have been having a few IT issues, if you're experiencing slowness with the server, just apologize, we're working on it. Let me pull these up. So all the non-movers closed out. These have been really good this quarter. So, got 5 wins, good profits on all of them. So these have been good trades this quarter, the non-movers. So the bullish pre-runners, I think we have had a couple minimal losers. So we got 3 open right now, the one down, a couple borderline. Still got a few days left. I think these close out today. Yeah, we've had, so like Eaton Boyd and then Travelers. So a couple of losers, not as spectacular. We're still up, but not a banner quarter so far for the bullish pre-runners, but not losing, which is good. I think the bullish runners are doing fine. So we're up. Yeah, we got a couple here. They're down. Open trades. So we had one Nike couldn't squeak it out, but that one got closed out yesterday. And then the other ones hit the profit target. So doing pretty good. Obviously, the best trades have been the non-movers this quarter. So that's where we're at. A few open trades and continuing do the trades. So, sorry, I meant to pull up the plan. Any questions on earnings trades?
No, they're working good. I'm at about 70% win rate. So yeah, I'm close to 2 profit factor. So they're working good this quarter.
Yeah, a lot better than last quarter. So that's good.
Yeah.
All right, this thing's freezing up. Okay, I'll just end it here. Pass it on to Joe. I don't know if you got logged out there too, Joe.
Yeah, Josh, it's a struggle.
Here's the, obviously you can always pull up the plan. So still got a lot of trades left here. This would be the end here. So this would be next quarter starting. So still got quite a few trades to go through here. So anyway, okay, I'll pass it on here. Joe.
Yeah, Josh. And hi, everybody. Let me pull this up here, and I put something together, for looking at extremes in the marketplace here. So anyway, I think, we've shared this over the last few weeks, this state one, longest runs, SPX, NDX, and Russell. The average, if you take the 5 longest run, different time periods, going back to 2007, the average, for SPX, if you take the 5 longest runs and take that average is 120 days, NDX a little longer at 126, and Russell a little shorter at 106. Let me pull up. Here's the new UI, and as Josh said, we apologize for struggling with the back end performance here. You can see the sector review. It's all odd numbers and all bullish. So, we've talked a little bit over the past month or so just about, extremes with the pie. And I think, Sadir, you had, brought up, the pie a long time ago and just tracking that. So I went in and put together a little sheet on the SPX, and I'd like to share this with everybody. So, historical long runs at SPX, as I said, averages 120 days. There are the 5 time periods. And so I'll break them down a little bit, but on average, we've had 56 state one occurrences going back to 2007. On average, state ones, are essentially 43 days, for the average SPX state one run. Average move, 5.8%. We're at about, 11.5 right now, and we're 80 days in. So, 80 days in, 5% average run, we're at 11.5% now. I went back and looked at the average run of those 5 longest periods, okay, where we were in state one. On average, it's 120 days, but the average return of those state ones, or appreciation, the SPX, entry date versus exit date, was basically 13.6%. We're talking 13.6 versus on average 5.8, but we're currently banging up, somewhat close to that average at 11.5%. Now, individually, the 21 period, the return was 12.5%. 2012 to 13 was 19%. 10 to 11 was 20%. And then the last 2 periods were about 8.5% and 8% respectively. So on average, a little over 13.5%, and we're not too far off from that now. So then what I wanted to do, and whether we're going to get out to one of those extended periods, only time will tell. Today's a little bit of a test. I did not get a chance to do this on XPX, on NDX yet, but I wanted to look out a year from those exit dates, which is what I did. So, a year out from the 21 period, we had a bear market. That takes us into September of 22. So the returns from the exit point to, 1 year out, which was basically, September of 22, close to the market lows, was down 11.5% in that bear market period. Okay, from the exit date, I picked 1 year out. 1 year out for the other 4 extended periods yielded the following returns. So, just thought it was interesting. It wouldn't surprise me if we, kind of keep that pie, strong and SPX in that range, for another period of time.
So does that mean that on the 4 that were up, that it went to state 2 and then back to 1 in general? Is that what you saw?
Now, all I took, Sudhir, I didn't analyze, the state transitions after the exit date. I just took the raw, date of the SPX at that time.
Okay.
And going back a little ways ago, I had, taken a look at the average pullback on some of these things, and I think it was somewhere in the neighborhood coming out of that, extended state one, was somewhere in the neighborhood of 4 to 7%. I think the average pullback. But yeah, I just took it a year out and looking at overall returns. So time period wise, then, if we take the 120 days, we're at 80 days now. You add another 40 trading days. From here, it takes us out to the kind of the mid-September time frame, mid to late, if we're, going to have a, one of these historically long state one SPX periods. And one thing I did notice in these 5 extended periods, on average, the high for the SPX occurred about a month before the transition date. So the range was anywhere from what was it? I think 2 weeks to 6 weeks, but on average, about a month before we transitioned. Which puts us potentially not too far from the current time frame. And then just, again, looking out, not analyzing the various state possibilities. If we were to go extended into the September period, averaging, somewhere in that 120-day period, without analyzing the interim period over the next year, 1 year out, obviously takes us to the 2024 presidential election. And it'd be interesting to see, if you take away the bull market, the returns have been pretty good a year out from the exit date. So, just, a few different perspectives as we, get out here, an extended SPX state one period at 80 days. So, I think
that's very interesting. I have a question. When something leaves state one in the Delphian system, is it usually when the price level hits like stop loss one, or if it's past T3, it goes back to T3? Or is there some kind of way to anticipate that, watching the price, that it's going to move out of state one?
I'll comment quickly, Sudhir, but then I'll turn that over to Josh. And one thing, it is certainly not, an issue where, it hits a stop loss level. But Josh, it's really a question for Ashok and his secret sauce. We have, we don't talk to Ashok all that much. Hopefully that's going to, change, before too long, but we'll see. We've talked a little bit about transitions, and I don't have any black and white for that. Josh, any thoughts?
No, I mean, I think it's, a range of factors like momentum. It's not particularly the price levels, but, I think it's more of like a momentum type thing.
I did find it interesting that time period for a top in advance. And again, unfortunately, just haven't had enough time yet to maybe get into the weeds with this, more. Ashok, one of these days, will be able to join us more frequently, but we can't tell you exactly when that'll be. So
yeah, even then it might be his proprietary formula.
Mhm.
But if the peak is coming a month before the exit date, this implies that the SPX was dropping, or at least flat, for a month before it exited state one. And then it must have hit, let's say it was above T3, it must have hit T3, maybe even T2, and so on the way down. And so it's probably proprietary how that's done, but it'd be interesting to know if there's any way to anticipate it.
Yeah,
If we can wrestle it out, go ahead.
You can pull up those charts, the modeling charts, and just look at them,
Yeah.
So,
they're all above. I mean, if the average is 5, they're all above. The average. I think they're above T3 on all those, I would guess.
Mhm.
It's like all running off the chart, like we have. So
that's hopefully a little bit thought provoking. Nothing black and white here, but just wanted to look at a little bit of history, on the extreme side, and offer a couple statistics. So that's all I have for today, gang.
yeah, that's a great analysis. Very interesting.
Very interesting.
Mhm. Okay, well, thanks, Joe. I think we're gonna close it up here. Does anyone have questions, comments before we wrap it up? Yeah. Okay, Well, thank you all. We'll do it again next week.
Thanks, everybody. Bye-bye.
Thank you.
Have a good week. And